Welcome to the Master Your Millions podcast, the show all about your financial potential and leaving a legacy for future generations. Here are your hosts, Jason and Scott Henderson.
Hello, everyone. Welcome back. I am your host, Scott Henderson, and my co-host is Dr. J. We're experienced investors with a huge advantage over 100 years of wisdom and experience in investing. Jason, tell us who we have coming on today.
Well, before I do that, I wanted to, Scott, you and I have had a discussion before that we're always seeming like when we talk to people, they have this urge to go play big, play the big leagues. You got to go big or you got to go home. You remember those discussions?
Oh, of course. We talk about it all the time.
Well, today we're going to scratch that itch. We have a great guest with us that has basically done some of this going big. We have with us Ryan Enck, who is a father of 5 boys. I don't know what it is about the girls, whether he's unable to do that or what, but he's married, of course, lives in the New Orleans area. He has done over 1,000 projects, and he and his partner has done 3 round-trip investment loops. I'm not sure exactly what you say there. But let's actually start there. Ryan, what do you mean by that when you say 3 round-trip investments?
Well, first, thanks for having me on your show, guys. And for those of you that are listening that are fortunate enough to stumble across this podcast or you recommended this podcast, I can tell you from personal experience that Scott and Jason are very high value providers. And just by listening to this, I am certain you will stumble across an idea or 2 or all of them that would have the ability to make you extremely wealthy. So I really appreciate you guys doing this and sharing your wisdom, experience, and knowledge with everybody. That's a long-winded answer to your first question, which was round trip. So in the business, in the apartment real estate business, a round trip is when you go from acquiring a property to refinancing the property and then selling the property. You've gone through the full cycle of the property. And so with one of the particular strategies that we utilize is called value add, where you basically buy under value. You do something to increase the value, either on operations or in renovations, and ultimately adding rent and adding NOI, net operating income. And in doing so, increasing the value, you refinance, pay all the investors their capital back while they still have ownership in the property. And then finally, at the end, you sell it. A good round trip investment has a couple ways of getting paid. Number one, you get paid on preferred returns. That's before the general partner gets paid. You get paid preferred interest. It's typically somewhere from 6 to 10%. We offer 8%, our company. And then the other way is through cash flow. So after you get paid your interest back first, then the cash flow is typically split between the general partners and the limited partners. That's anywhere from 20% to the general partners to 20% to the limited partners. It just depends on that particular syndication. And then the third great way to get paid is through refinancing the property. A good refinance is anywhere from 75% of your capital back to 100% of your capital back. Obviously, a grand slam is where you get more than 100% of your capital back. And you're paid on debt, by the way. You're paid with a loan. So it's not true income, so you don't get taxed on it. You just get your capital back. And then the fourth great way to get paid during a round trip is through depreciation. Cool trick in real estate where you can do something called a cost seg, where you can take 27 and a half years of depreciation and condense it down to 7 years. So for example, one of our deals, if you were invested $100,000, you'd have gotten $56,000 in depreciation that you could write off against your other income. Anybody who's been stung a little bit by taxes really appreciates that part of the investment. The last and final way of getting paid during a round trip is once you sell the property, you're getting that split of whatever that profit is. So hope that that was kind of a full scale answer to that question, but that's the gist of it.
That's awesome. I really appreciate that answer. And I'm sure a lot of people have not experienced that. That it's kind of, in some circles, probably fairly rare, and other circles might be fairly common. You said that each round trip was 1,000 doors or something like that. Was that correct? No, it was over 100 million, I think it was, that you're saying that you had done in those 3 round trips.
So we've got over 100 million in assets under management, but in round trip investments, it's been around 20 to 30 million. It's different properties. So it's, I might have done a round trip with a 60 unit or a 50 unit or 100 unit. But it's you call the round trip just the property in and of itself.
So one point in time, you were a podcaster like us. Yeah. And as part of that, you had this challenge, I guess you would call it, where you said, look, I'm going to purchase 1,000 doors in 1 year. Was it the 1,000 door project? I think it was, or challenge. Maybe it was a 1,000 door challenge. What gave you the idea to do that?
A lot of times it's inviting people along the journey with you. And I believe that if you set a goal, then one thing that holds you accountable to that goal is to put it out there. And put it out in the ethos on the internet or wherever else. And that was just something where I had this goal and my partner had a goal. Hey, let's do 1,000 doors in this next year. And it was something that everybody heard about, that was listening to the podcast. They're following along with the journey and seeing the peaks and valleys of the challenges of that process. It's almost like a reality TV show, But at the end of the year, yeah, we ended up buying over 1,000 doors. So it was just something that we set the goal, put it out there, create a podcast around it, and it was fun. It was fun to document the journey.
Yeah, that's a blast. I'm looking at it right here. It looks like the last update was April 16th. So you did make it to 1,000. How was it? Right at the end of the year? Was it at the April 16th? You did it in 3 months. How long did it take?
So actually we set that goal like right before the pandemic hit. So I'm making an excuse, but it took us about 3 months longer than a year.
Okay.
If we would have gotten 200 doors, we would have been happy, but the 1,000 really made it fun. I remember the story, this guy, he was a blogger, and he decided that he wanted to put it out there that he wanted to take a paperclip and barter all the way up to getting a house with that paperclip. And he wrote about it every single day, and he put it out there. And what ended up happening is people ended up helping him along the way to help him accomplish his goal. And that's kind of what happened with the 1,000 the 1,000 door thing, is that we kind of put it out there. We had people contacting us saying, hey, look, I got this really great deal that would help you get to your 1,000 door journey. Or people contact and say, hey, we got some capital. If you ever need anything for some of these deals that you have, let me know. So it ended up, just kind of assisting us along the journey.
That's incredible.
That's
absolutely incredible. What was like the one takeaway? If you had to boil it down to one thing and had to go back and redo it, what would be the one takeaway you'd go back and make sure you learned?
Oh man. I think the biggest thing is just transparency. And I think that's something that it really gave us, that we shared our struggles and our failures just as much as we shared our successes. So that, when people were dealing with us, whether it's on the, hey, let me find you a deal side, or, hey, let me provide capital side, it was, I know exactly what I'm getting. I've seen not just that this guy, is out there saying that everything he touches turns to gold. We've also seen his failures. We've also seen some of the things that he's struggling with. And so I would say that's probably, that's probably my main takeaway from that.
So what was your biggest failure then during those 13 months? 15 months, excuse me. 3 months longer than a year. So close.
Yeah, so I mean, we had some challenges that you just can't anticipate. So when we were buying one of these properties, we said, I remember an investor asking me, well, what's the worst thing that can happen? A storm, a hurricane, or what could happen? I was like, well, the worst thing that happens is we don't really hit our projections, but if a hurricane or something hits, we'll get an insurance claim. Well, the worst thing that happened was we were hit by a hurricane, two of them, and the insurance company made us sue them in order to get paid out, plus uh, plus a pipe freeze, plus a pandemic, you know, plus a moratorium on collecting rent. So it was like, you really couldn't anticipate all those things. And we shared those challenges. Now, what ended up happening is we ended up getting paid out $3 million on this insurance claim. We ended up in a way better position than we were before. We ended up, just getting a complete haul over and bumping rents, and refinancing sooner than we thought we would. So, these challenges and these struggles ultimately lead to some sort of, victory in the end. But in sharing those challenges, I think is helpful.
Love it. Tell me, when you were 5, I'm pretty certain you weren't running around telling your parents, hey, I want to buy 1,000 doors when I grow up. Where were you when you were younger? What did you want to do? And how did you discover your talents in this area?
Yeah. So when I was 5, I was jumping off the washing machine wearing a Superman cape.
Sounds familiar.
Yeah, I didn't know what I wanted to do, but I was actually born in Salt Lake City, in close to your neck of the woods, and my parents moved around a lot, and in moving around a lot, I just kind of developed this taste for real estate. I just understood markets, I understood different markets and how to look at them and evaluate them. And even going into college, I was always interested in real estate. And when I graduated, I became a realtor, and I was also a teacher. So I really didn't know which direction I wanted to go. But it's kind of one of those things where I honed in on the talent, and a big part of that was I kept on having kids. So I was like, I can either do real estate, which I'm good at, or I could teach, which I'm good at. But one of them is going to pay for these 5 kids, and one is not. So I ended up, kind of tipping the scale towards real estate. Kind of interesting journey I went on is kind of talking about your concept of playing big and playing small. Because I started out small, and I think that most people starting out, they just think, man, real estate, you can make a ton of money, but they don't really know where to start or how to do it. Are you going to be an active investor? Are you going to be a passive investor? For me, I was like, well, I'll be a realtor, which you're not even an investor. You're just brokering sales. You're just a salesman. And so, I mean, you learn in markets, but you're a salesman. And so I think a lot of people, there is a gradual process, and there was for me, in kind of understanding where to play ball. And I ended up settling in with doing a lot of foreclosures, a lot of owner finance stuff, a lot of flips, a lot of buy and hold in single family, and some smaller, like 4-plexes to 16-plexes. In the same time frame, I had a friend of mine that also had 5 kids, and his brother graduated from Harvard. Once his brother graduated from Harvard, he said, hey, let's blow up a real estate business. And they started right out the gate. Instead of going for single family and smaller multifamily, they started going for bigger stuff, 50 units plus. And at a certain point, they said, we don't do anything unless it's under, 200 units. In that 10-year span that I was developing what I thought was like my own little mini real estate empire, had hundreds of, like single family, like over 100 single family houses and 4-plexes and duplexes. They had developed a business that was worth over $4 billion in assets under management. And this was...
But you kind of cut out there. I want to make sure I heard you. That was with a B, correct? 4 billion?
Billion. Yeah, billion. Yeah. and that was just using this model of that round trip, of that value add model, the buy low, add value, refinance, and then sell later in like the 7 to 10 year time frame.
Is that's what gave you the idea then that you're going to start going big, when you realize that here these friends in the last 10 years have done this and you've done something? I mean, you've been successful, however, nowhere close to what they had done.
Yeah, I knew my buddy, and he, I thought that I was just as smart as him, and I was like, well, if he can do it, I can do it. Why am I not playing bigger? And it really just came down to money, and I was just thinking of my own money. And once I learned kind of the syndication model and the fund model, I was like, well, there's really no end to scaling this, and you really can't scale something that's in the 2 to 4 unit range or even 16 unit range. You can get to a certain point, but then once you need to get, you need to put in management infrastructures. You need to look outside your own area if you're going to continue to find deals. That scale happens at the 100+ unit mark.
What would you say? Go ahead, Scott.
I was going to say, so what was your first step? You're sitting here, you're playing your big fish in a small pond, looking to become a big fish in a big pond. But what was step one? I mean, a lot of our listeners are sitting here like, well, how did he make that transition? So how did you go about doing that?
Yeah, so that's a good question. I would say that, the answer might surprise you. I was at this conference where one of the speakers, I think it was the guy who started Keller Williams, and I remember him sharing this specific story where he paid $1 million to go sit down with Richard Brunson on his island for a day. And his whole point was, if you want to get to the next level, you need to be around people who are at that next level. And and so he just was willing to pay $1 million to sit around and watch this guy's behavior and ask him questions and pick his brain. So what I did is, when my buddy was telling me this, I said that he had developed his empire of over 4 billion worth. I said, can I just fly down to Tampa Bay, just stay with you for like 3 or 4 days? I just want to pick your brain and understand your operation. He was amazing. He flew down. He introduced me to all of his key people. Myself and my business partner Preston flew down with him, and basically we had a notebook and we were just like fire writing everything down, and just had a complete understanding of how the whole model worked after that. After that, it was literally 2 to 3 months later, we bought a $5.6 million deal, a 62 unit. We've already refinanced that deal, and we're about to go full cycle on that one. But it's sometimes just the littlest thing. It's that knowledge that just propels you to the next level. And that's what it was for us. It was, oh, we can do this. Oh, this is how we finance it. Oh, this is how we get the investors lined up. Here's how we structure the deal. And it was just that simple 3-day meeting that propelled everything.
Wow. It seems, I need to point something out very specific. When it used to be that you could not run faster than a 4-minute mile. And then I'm trying to remember the track star's name who did it. He did it the first time, and the next year you had, who was it, Jason?
Roger Bannister.
Roger Bannister. And then in the next year you had high schoolers doing it. You had 5 or 6 the year after that. Now it's a common occurrence. And so just simply allowing yourself to think, how do I do that? It changes your mindset so that you can do that. That's absolutely incredible.
Yeah, I want to add to that you not only allow in your mind how you do it, it's important that there's a who there, right? There's a key who. I mean, Ryan had a buddy who was a mentor. You mentioned, Ryan, that you have a partner. Who are some of the key people that you have around you that's basically enabled you to do that? I'm assuming that you wouldn't be able to do as much as you do, or have been able to even pull that first $5.2 million deal, pull the trigger on that one without your partner.
That's a huge point, and that's one of the things that we learned with the guy that we went and met with. Because I was like, man, I remember you from college, and I don't remember you knowing all this stuff. And he's like, I still don't know it all. And he's like, but that's the difference between an entrepreneur and everybody else. Everybody else says, I can't do that because I don't know how. The entrepreneur says, I don't know how to do that, so who can help me with that? So they replace people with trying to learn everything and do everything on their own. So I had a guy that I was already partnered with on smaller real estate deals. And we were both doing these smaller real estate deals together. And once we learned the model, we started going after it, and we said, all right, what's everything that we don't know? Let's make a list, and who can help us do that? So we needed a good lending source. We needed to understand how to utilize our networks. We needed somebody who could manage property. We needed a regional property manager. We needed an asset manager. We needed a bookkeeper and accountant. Those are some of the key players that we use to get started.
And that's built from there to where you have multiple bookkeepers, or has there been additional key players as you've gotten bigger?
Oh yeah, there's been additional key player. Like, the next key player that we probably, obviously administrative assistants kind of help with some of the smaller stuff. But then we hired an acquisition analyst, and this is the person that goes out and he's looking at all the deals. He's developing the relationships with the brokers. He's getting first look at deals. He's making, 5 offers a week and trying to find you the best deals. He's traveling and analyzing the different comps in the area. Before, it was us doing that. And I still do a little bit of that, mostly because I enjoy it. That was a key player to add, was the acquisition analyst. And then also, once you're dealing with a good bit of investors, you want some investor relations people. A regional property manager. You're going to start with just obviously one property, but eventually you're going to span to a bunch of different properties, and having a regional that can offload all of that on you, or for you, and kind of propel things better than you would with experience, then that's another key person.
Okay, we might be going a little bit back in time here. However, at some point, did you ever feel like, your wife made me thinking you're crazy doing this real estate thing and not sure whether she wanted you to do that? And now you've proven yourself. Tell me a little bit about that, your relationship with your wife and your family, and how that's been going through this journey.
Yeah, so I was blessed enough that when we first started, when I was teaching, we didn't make a ton of money. And Hurricane Katrina hit, actually when she was pregnant, 8 months for our first child. And we lost the house that we had. We were basically homeless, about a month before we had our first child. And so she had been at the bottom with me. And being at the bottom with me, it was easier to take risks in order to get, in a better position where we are now. So I think her propensity for risk, by the grace of God, has just been from being at the bottom and understanding how we've continued to climb. I think it's a little tougher for guys that have a lot of money already and are trying to get their wife on board with a new venture. I see that that's a little tough. But my wife and I, marriage is something that it takes work. You can't just set it and let it go. So we get up every morning and we pray every morning, and we share, what we're thankful for. We typically have some scripture that we reflect on, share our intentions, and plan for the day. And, I'm constantly telling her about what's going on in business, and she's seen me fail and succeed enough that she just kind of lets me go with it.
Does she ever, since you guys set your intentions and goals, I would imagine, does she ever come back and say, Ryan, those are too small, like think bigger? Or
yeah, a lot of times she's like, don't you think you should be thinking a little smaller? Because I tend to think bigger. But no, she's come back and said, hey, maybe you shouldn't have invested in crypto at that time. Um, but but other than that, no, she's generally supportive of a lot of my ideas. There's some things that she's like, you've got this skill set and this skill set, and what you're thinking of over here is way outside the box. Unless you're extremely passionate about it, maybe you should just get back and focus on this one thing you're good at. And that's something that's been a real blessing to have, because entrepreneurs tend to focus on like 20 different things. And it's like trying to nail down 20 nails with 2 hammers all at once. It's not an effective way to live. But it's kind of like chasing the shiny object type thing. And that's something that my wife has reined in on me is, hey, I know you see opportunity and you're a guy that takes action. You want to go after all these opportunities, but maybe just focus on, these 1, 2, or 3 things that you're really good at. And it probably you can expand from there.
I see. So looking forward into the future, where do you see yourself 3-5 years down the line?
Yeah, so we launched our $100 million fund about a year ago. We're having a lot of fun with the real estate that we're doing. We've got some really amazing deals. We've been doing hotel to apartment conversions. It's been really rewarding to provide solutions to problems in the marketplace. Affordable housing, that's a big problem. I mean, you can't build economically, and rents are skyrocketing. So we love some of those deals that we've done where we've been able to provide that solution in the marketplace, and they've also been very lucrative for the investors. We love some of the deals that we're doing with arbitrage. Like we just bought we're about to buy, a big 67-unit luxury apartment that we're converting to condos and selling them individually to Airbnb investors. So we love, we think of ourselves as, people that provide solutions to problems in the marketplace. Our skill set just happens to be real estate. The name of our company, if you see this is on my desk every day. It's Servio, which is Latin for to serve. And our mission is to just take our gifts and talents and serve as many people as we can with those talents. And that's from a quote, I think it was Albert Schweitzer, that said, "This much I know, those of you who will truly be happy will be those who have sought and found a way to serve." So where do I see myself 5 years from now? I see myself continuing to serve communities, serve investors, serve our residences, by providing solutions to the marketplace, whether that's providing affordable housing or providing Airbnb investments or new home ownership. That's kind of where our heart is, whatever's going to serve people the most.
That's really cool. You recently put out there that you believe and I'm not sure what that is. Maybe you can talk a little bit to that. You believe that we are in a 7-year window where there is huge opportunity to make significant amounts of money based upon what's going on. I mean, you've even said flat out, I don't believe we're crashing like a lot of other economists and other people are predicting. We're going to go into a massive recession and everything's going to be awful and everybody's going to be sad and there'll be a bunch of this and that. You really feel like there's an opportunity. Talk a little bit about that. Why do you feel that way, and what are the triggers there?
Yeah, I mean, from a macro level, I think we are in the 7-year window of the biggest wealth transfer probably in history. And in any recessionary time, any inflationary time, which we have all of that going on now, the best places have always been in real estate or cash flowing businesses. Obviously, scarce assets like gold, silver, case for Bitcoin. I think that we are in that window right now because of all those elements we have going on. And, talking about recession, like I call it a fake crash. And this might surprise you, and it's a trigger for some people, but I think that, 2008, everybody remembers 2008 with real estate. that was, in my opinion, a fake crash. A crash is, to me, you're totaled. You stay at the bottom. But if you were a buyer, the median price of a house in 2007 was $257,000. That was the average price. If you were to buy a house in 2007, the next year it crashed, you lost about $30,000. And it took about year 6 to where it was worth $257,000 again. So that was a little bit of a dip. And if you waited 10 years, your equity would have been $80,000 higher than what you had bought it for. That's not a crash. That's a fender bender. When you're looking at things from a macro level. Now, one of the main differences between now and 2007 is what was inducing that crash were loans that were basically turning people who weren't really buyers into buyers. So the waitresses, the service industry people, people that didn't even have any W-2 income or their credit score was down there. They should never have been buyers. They were always renters. But the government put them all into the buyer category, and they shouldn't have been buyers, and they defaulted on those loans. There were 12 million less people than there are now. 12 million less households than there are now in 2007. And back then, there was 1.5 million more houses on the market. So you take what's going on right now, and I do think that we will have a little bit of a fender bender in the next couple months, maybe even a year. But I call it a fake crash because you have 12 million more buyers, 1.5 million less houses than you had in 2007. People can't build houses economically or fast enough to keep up with that population. So I think all that's going on right now, what you're about to see, is say you're in a community where you have small community, say 200 people buy per month in that community. Well, they're just staying on the sidelines. It's not like 2007 where those buyers went away. There were no buyers in 2008. Right now, the buyers are still there. They're just like, oh, whoa, the interest rates are super high. Maybe I should stay with mom for a while. Maybe I should, rent for a while. Maybe we could just stay in our house and just live a little more snug with this, with this new child that we just had until interest rates go back down. But what that does is it just pents up. It's causing a pent up demand. So you take those 200 buyers in January, add 200 more in February, now you're at 400, add 200 more in March, now you're at 600. Add it for a year, now you're at 2,400 buyers. And then the interest rates go back down, or people get used to the interest rates being where they're at. You have the same amount of supply of houses on the market, but instead of 200 buyers, you have 2,400. So I hope you can replay this podcast a year from now because I'm predicting there's going to be an extreme surge in the cost and the value of real estate a year from now.
How about we one up you there, and in a year or so we bring you back as a guest, and we'll revisit it. Maybe play a recording, say this is where it is, and this is what's happened, and this is how responded. One of the things we have noticed that those that have been very successful are willing to give up on an idea. They're willing to unlearn what they've learned and learn something new. And so, someone like yourself, you could be completely right or you could be completely wrong. It doesn't matter, for the fact you're going to adjust and move laterally or, forward, backwards to take advantage of whatever there is. What would you say is one of your secret, I don't know, would you call it a secret weapon or something when you're looking for a project or an area that you want to invest? What's some of the criteria that you have in looking at a project? That didn't come out very good. I know they'll edit it, but whatever. So what is something that you look for in an area and a project? What are some criteria you look for you to say, yeah, I'm going to take a closer look?
Yeah, I mean, you want to hedge all risks. If I were to say, the number one secret, you've heard it before in real estate, is location, location, location. Very, very specifically, the number one secret in real estate is population, population, population. So we look for the first criteria that we look for if we're going into a new area, or if we're investing in the current area, is positive migration. Are there more people going into that area than are leaving it? And then from there, you want to look at diversification of industry. Is this, just a coal mining town where if they stop mining coal, then you're just left holding the bag, or even the shale oil boom in Dakota, where there was people that were building all these places to supplement that industry, and then all of a sudden they shut it down. So you want to look for a diversification of industry, hospitals, education. It's not my personal philosophy to expand the government, but government jobs never really go away. So that adds some stability. It adds some stability to a region, and then diversification of tertiary industry. So positive migration with those factors, that's the number one thing we look for. But then, of course, there's other things that hedge your risk. Cash flow. Is it cash flow positive? If we enter a recession, if you look at rents never went down during a recession. Rents have gone steadily up since people have started renting things in areas of positive migration. The value might dip a little bit, but rents continue to climb. So as long as you're willing to hold a property for cash flow, then you've hedged all your risks. So that's a few of my criteria, and the secret sauce is positive migration.
Would you say, I've heard the analogy before that in real estate, you can kill the cow or you can milk the cow. And that's as far as how long you hold the property, right? Are you more of a hold it long and keep the cash flow, or simply case by case basis? What's your criteria to make that decision?
Yes. So for me personally, there's a difference between me personally and what the investors want. If it were up to me, I would never sell anything. It's great having cash flow, and you can always refinance and take the debt out. But we have a lot of fun with all the strategies. There's quick nickel and slow dime in real estate. You can either make quick nickel by flipping something real quick, or you can get that slow and steady income. I enjoy some of our shorter term properties because it's fun to 2x or 3x an investment. You got $100,000 you put down on something to get 200,000 back to 300,000 back in 3 years. That's outstanding. That's fun. But eventually you want to probably take that chunk of money and put it into something longer term where you have those benefits of the depreciation. I would say the smartest thing to do if you're a patient investor is to do something at about do something with a refi in 2 to 4 years with a 7 to 10 year hold. That way you're maximizing your depreciation, that cost seg, condensing that's 27 and a half years down to 7 years. You're maximizing the benefit of that while being patient enough to let that cash flow grow over 7 to 10 years. And then, of course, if you're going to sell, you better find something else better than what you're in now.
Yeah. Need to roll that money continuously, 1031 it.
Yeah.
So then what was it just the investors that wanted to sell the California, the 167 units that you were talking about earlier? Is that why you didn't end up holding on to it? Because I know that you were looking at companies to manage those Airbnbs.
Yeah. So that's a little bit of an arbitrage model that we enjoy. The hotel to apartment conversion, that's arbitrage. It's basically taking a use and then changing it to make more money. When we looked at that deal, the cash flow wasn't enough just by holding onto it as apartments for us to really meet our investment criteria. Like we want to get something a minimum of 17% IRR. We want to do a minimum of a 2x of the money. And when we looked at it as apartments, we said we might be able to achieve that, but we're not being conservative in our projections. So then we looked at it and said, all right, well, as apartments, it's doing this. I think we're buying it for $227,000 a unit. And then when we went in the market, we said, well, as condos, these things would easily sell for $400,000 a piece. And so that was just a simple decision on, hey, what's the best strategy for this particular property? And it's obviously, if you can make a $280,000 spread on 167 units, then that's probably going to be your best use of that property.
Okay. So then, I'm trying to think. I had a question on my mind and it just completely slipped it. So tell us a little bit about Bella de la Mar. That's the first project that Jason and I got involved with you on and brought some of our own investors in. We've enjoyed our relationship with you there. Why'd you decide to hold on to that one versus just converting it, selling off the parcels?
Yeah, I mean, that one is kind of a nice area where, if we looked at it on an arbitrage model, I'm not sure we could get that much more. It might be $10,000 to $20,000 more per unit if we sold them individually. It was only, I'll forget what Bella is, 40 units or 50 units.
I believe it's 40.
Yeah. So, I mean, that would be kind of a smaller scale thing. But then when we looked at all the benefits as a longer term hold, 7 to 10 years, where we could do a cost seg on it and give those depreciation benefits, that was the best use of that property. That's the best way to get the max value out of it. We also looked at the rent bumps and we said, man, we can bump rents $200. We've since bumped rents by $400 on that property.
Well, and newsflash, that property got hit by a hurricane. What would you say was percentage of a renovation with that property?
Oh, we had to renovate the whole thing. Yeah,
to the studs, or how much was? I mean, it was right there on the water, so it got hit pretty hard.
Yeah, the downstairs we had to renovate to the studs. We could leave the upstairs alone, but that was one of those things where, going through Katrina and going through storms and going through insurance claims, sometimes the best thing that can happen to you is you get hit by a storm. And then you have to gut something, because that particular property, you guys bought it. We projected a 2 to 3 year refi. We're not even at year 2 yet, and in about 2 weeks, we're refining out and providing 100% return of capital on that. So we were able to go in, use the insurance money, do a full scale renovation, and get $400 more than what we were getting before on rents. It just made it easy to go out and get the refi on that.
Yeah, and I need to pitch in here. Like, Ryan's being very modest. It's been like 15 months, just before 2 years. No, it's been about 15 months, and everyone that we've brought into it has just been absolutely thrilled. Not one distribution was missed. On top of all that, a lot of our clients who came in and invested through their insurance policies, things that we taught, are just absolutely thrilled, because not only are they going to get their money back, but we all still got ownership in this property, and they're clamoring over getting to the next one and the next one, and wanting to know what's coming down the pipeline so they can set cash aside to be involved. Ryan's one of the best at when it comes to these things.
Thank you so much. I believe you guys got a good tax deduction as well when you got your K1s.
Yes, we did. That, I think it was 54% of every dollar we put in, we got back in depreciation. That's the beauty of this space. That's why we love it.
Yeah, excellent. Well, it's been a great project, and we look to just repeat that all over the place.
And obviously, when this 7-year window, you believe that there's lots more projects out there. So someone could come in and contact us, through the show notes, and find out how to get hold of you and figure out how to, maybe become an investor with you. However, they could also start to find out ways, kind of follow you. I know you have some following on LinkedIn, some other places, to kind of learn from you, if you will, to go to the next level and maybe even do a syndication themselves. How would someone best garner information from you?
I'd say like the best content that we have out there is actually on our YouTube. We've got a YouTube we started back in the day called Cash Flow Dad Life. the name was from wanting to provide fathers with some passive income. My wife has since told me that it sounds like you're just bragging that you're a rich dad. But I've never changed the name. It's called Cash Flow Dad Life. It's just about, how cash flow helps you provide.
I'm going to change your contact to my phone now.
Yeah, please don't. But yeah, that's probably the best way is on the YouTube channel. Also, when we come up with new opportunities and new deals, we release it there first. The best exclusive access to our opportunities is through serviocapital.com. If you register as an investor there, that list of investors gets first look at our deals before we publish any opportunity to the general public. So if you want to be, you want to get first look, they do typically fill up fast depending on the type of investment. But if you want to be part of that, get first look at the deals as they come, you go to serviocapital.com and register as an investor.
So another good way that you could maybe even pitch, say, go through the show notes and, click on the link in the show notes, and that would give us an opportunity to like capture them, so it could be like an affiliate or something. I don't know whether you feel comfortable with saying that, so we can do something like that. Just do it. We'll edit it.
Okay. Yeah. So, I mean, the best thing to do is probably go to the show notes, and there's a link that gives you access to our website that will give you exclusive first look on deals as we get them. We send that first to the list of internal registrants and investors, and then we publish it to the general market. So if you want first look at those deals, go to the show notes, and whatever link that Jason and Scott put on there, you want to use that link.
Cool.
Yeah, and that's important. He says it goes out to certain people first. I mean, I have seen deals come through, then you're looking for X amount of dollars, and it's funded in 48 hours. When you go out to your list, they look at the numbers, look at the project, and I've seen it go very fast.
Yeah. It's fun for me when it goes fast. But yeah, it's definitely something where, when we first got started, it might have taken us a couple weeks. And we put it out to the general public. Nowadays, typically, if we put it out to the general public, it's already been funded through our exclusive list.
Cool. Well, Brian, we appreciate you coming on. Thank you so much. Any last words?
No, thank you guys so much. And thank you for all the value that you guys are providing to people to help them master their millions. So I really appreciate what you guys are doing. And thanks for having me.
Of course.
Thank you.
Jason, final thoughts?
No, I'm just grateful. As a treat to have Ryan on the show today. I've been looking forward to this interview for quite some time. So it turned out better than I thought it was going to be. Thanks, Ryan.
I agree.
Awesome.
I can't wait for Ryan to come back on in a year. It'll be fun to see how the whole landscape is completely changed. So put it on the calendar. Anyways, guys, as always, you can connect with us on Facebook, Instagram, or Twitter, or shoot us an email. All the links are in the show note description down below. Remember, mastering your millions all starts with your mind and your team. Make sure they're the best. Catch you next time.
Thanks for listening to Master Your Millions with Jason and Scott Henderson. Check the show notes for any links or contact information about today's guest. Make sure to follow the show so you don't miss any future episodes.